We put this video together as a guideline to help you understand the monthly asset allocation update. As a rule of thumb, the standard recommended asset allocation for the typical investor is 50% stocks, 50% bonds. In some instances, we may deviate a little bit based on an individual's investment objective, risk tolerance, or time horizon, but in general, we recommend a 50-50 stock-bond allocation. There are times, however, when the market can become significantly overvalued as to represent a high risk for a correction or downturn. We saw examples of this in the real estate markets in 2005 and 6, and in the stock markets in 1999 and 2000. These instances are typically characterized as times of excessive greed and euphoria in the marketplace, followed by a severe and punishing correction. If we perceive the stock market to be significantly overvalued, we would want to minimize our exposure to stocks by dropping our asset allocation down to 25% stocks and 75% bonds. There are other times when the market can become sufficiently undervalued as to represent a unique buying opportunity. These instances are typically characterized as times of excessive fear and pessimism in the marketplace, followed by a strong and prolonged upward cycle. If we perceive the stock market to be significantly undervalued, we would want to overweight stocks to 75% of the portfolio to take advantage of the unique buying opportunity. Do you mean to say that when everything looks wonderful and everybody is buying, we would sell? And when everything looks terrible and everybody is selling, we would buy? Yes, that is exactly what we mean. As Warren Buffett likes to say, be fearful when others are greedy, and be greedy when others are fearful. Recall that the characteristics of an intelligent investor include being disciplined, harnessing your emotions, and thinking for yourself. So does the market give clues when it may be sufficiently overvalued or undervalued to warrant a change in asset allocation? Well, Benjamin Graham gives 3 guidelines for gauging the relative valuation of the market. They are based on the relationships between 3 variables: prices, earnings, and dividends. The first guideline is based on the ratio of prices to earnings, now commonly known as the PE ratio. Historically, the stock market has traded around a PE of 15 times earnings. A PE ratio above 20 to 22 would indicate the market has become overvalued and may be due for a correction. On the other hand, a low PE around 10 to 12 would imply that the market is trading very cheap and may represent a good buying opportunity. Graham's second guideline for valuing the market is based on the relationship between the dividend yield on stocks and the dividend yield on bonds. Historically, the yield on stocks has been lower than the yield on bonds. Stock investors have been willing to take a lower yield in exchange for the appreciation potential that stocks provide. The difference in yield between stocks and bonds represents the cost to the stock investor for that appreciation potential. When the difference in yields is high, it represents a high cost and maybe a time to limit exposure to stocks. When the difference in yields is low, it represents a low cost for the appreciation potential and thus a good buying opportunity. When an investor could capture at least 70% of the bond yields by buying stocks, it would indicate a good time to increase our allocation to stocks. The third guideline for valuing the stock market is found by comparing the earnings yield on stocks with the dividend yield on bonds. A yield spread of at least 4% would indicate that companies have sufficient earnings to not only pay their dividend, but also to reinvest toward the future long-term growth of the company. A negative yield spread would be an indicator of risk in the long-term outlook for stocks, and thus a time to decrease our exposure to stocks. Only if all 3 indicators were signaling either an overvalued or undervalued market would we change the recommended allocation mix. At all other times, we would advise maintaining close to a 50-50 stock-bond mix. To give you a sense of the frequency of allocation adjustments, the last time we recommended an increase to 75% stocks was December 2008, and the last time the indicators would have signaled a move to 25% stocks was in 1999. So we don't expect frequent changes in allocation. Nevertheless, we like to take a look at the 3 indicators every month just to stay current. So we'll be sending you a monthly update, and we hope this brief video helps you understand its significance.